You just checked the price of gold, $4,612 per ounce. Your stomach tightened. Silver is sitting at $85. You felt that familiar sensation, the one that whispers you're too late. Everyone who got in early made their money, and now you're staring at all-time highs, wondering if you're about to become the person who buys at the peak right before the crash. But here's what that feeling is missing. While you were hesitating, central banks around the world quietly purchased over 1,000 tons of gold last year, and the year before that, and the year before that. The last time central banks bought gold at this pace was 1967, right before the Bretton Woods system collapsed and gold went from $35 an ounce to over $800 in less than 13 years. The question isn't whether you're late. The question is whether you understand what's actually happening. My name is Alex, and for the past 8 years I've been obsessing over monetary policy, central bank behavior, and the signals most people miss because they're too busy watching price charts instead of watching what the people who control the money supply are actually doing. If understanding the real story behind gold and silver matters to you, hit that subscribe button and give this video a thumbs up so more people can see past the noise. Here's what I'm going to show you. Gold and silver aren't moving because of retail investors or even hedge funds. They're moving because the global monetary system is being quietly restructured, and central banks are preparing for a world where the dollar isn't the only reserve currency that matters. By the end of this video, you'll understand what Basel III actually means for gold, why nations are repatriating their physical reserves, and what it means when countries start settling oil trades in currencies other than dollars. This isn't about timing the market. This is about understanding the architecture. Let's start with what everyone can see. Gold hit $4,612 per ounce on January 12, 2026. That's a 6% gain in just a few weeks. Silver touched $85.75 on January 13th. These aren't small moves. But here's what's interesting. Retail demand in Western countries has been relatively flat. The futures markets show institutional positioning, but it's not massive speculative mania. So where's the buying pressure coming from? Central banks. And they're not buying in small amounts. They're buying at levels we haven't seen in modern history. From 2022 through 2024, central banks purchased over 1,000 tons of gold annually. To put that in perspective, global gold production is roughly 3,000 tons per year. About 2,000 tons goes to industrial use and jewelry. That means central banks are absorbing a third of the world's annual gold production. This is sustained, deliberate accumulation, and the list of buyers tells you everything you need to know about what they're preparing for. Poland added 83 tons in 2025 alone. Brazil, the Czech Republic, Kazakhstan, Uzbekistan, Turkey, India, and China have all been consistent buyers. These aren't countries panicking. These are countries positioning. Now, the last time central banks bought gold at this pace was 1967. If you know your monetary history, that date should make your ears perk up. 1967 was the year before everything started falling apart. The Bretton Woods system, which had pegged global currencies to the dollar and the dollar to gold at $35 per ounce, was under enormous strain. Central banks around the world could see the math wasn't working. The US was printing more dollars than it had gold to back them. So what did they do? They started converting their dollar reserves into physical gold as fast as they could. By 1971, President Nixon had no choice but to close the gold window entirely, ending the convertibility of dollars to gold and effectively ending Bretton Woods. What happened next? Gold went from $35 to over $800 by 1980. Here's the thing. Central banks don't buy gold because they think the price is going up. They buy gold because they think the system is changing. And right now, the pattern we're seeing is almost identical. Record gold buying, countries reducing their dollar reserves, nations repatriating their physical gold, and the development of alternative payment systems that bypass the dollar entirely. These four things happening simultaneously isn't a coincidence, it's a signal. Let's talk about the dollar's reserve status, because this is where most people get confused. The dollar isn't collapsing, it's not going to zero, but its dominance is absolutely eroding. According to the International Monetary Fund's CUFR data, the dollar's share of global reserves was 65% in 2008. By 2024, it had fallen to 58%. That's 7 percentage points. That might not sound like much, but we're talking about trillions of dollars being diverted out of dollar-denominated assets and into something else. And a lot of that something else is gold. But it's not just about diversification. It's about repatriation. Countries want their gold physically in their possession, not sitting in a vault in New York or London. Germany repatriated hundreds of tons from the Federal Reserve and the Bank of England. Turkey brought its gold home. Poland repatriated over 100 tons. Venezuela tried to get its gold back from the Bank of England and ended up in a legal battle that's still ongoing. Why does this matter? Because if you're preparing for a world where the dollar isn't the undisputed settlement currency, you want your assets under your control in your country where no one can freeze them or leverage them against you. And it's not just gold coming home. It's the dollar being bypassed in trade. China and Russia are settling bilateral trade in yuan and rubles. India and Russia are trading in rupees. China and Saudi Arabia have discussed settling oil trades in renminbi. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus their expanding list of partner countries, are developing their own payment systems to avoid SWIFT, which is dollar-dominated and can be weaponized through sanctions. Every one of these moves reduces the structural demand for dollars. And when structural demand for dollars decreases, the relative value of alternatives, like gold, increases. Now, stay with me here, because this next part is where most people get tripped up by headlines that don't actually explain what's happening. You've probably heard about Basel III and gold, and if you've been reading sensational articles, you might think Basel III suddenly made gold a Tier 1 asset, and that's why banks are buying. That's not accurate. Let me clarify what's actually true. Gold has been classified as a Tier 1 asset, meaning 0% risk weighting, since Basel I in 1988. This is not new. What Basel III did was clarify the distinction between allocated and unallocated gold. Allocated gold is physical gold that's specifically identified and segregated. It's yours. No counterparty risk. That remains Tier 1. Unallocated gold is essentially a claim on gold, a paper promise. It carries counterparty risk because if the institution holding it fails, your claim might be worthless. Basel III classifies unallocated gold as Tier 3, which carries an 85% risk weighting. That's a massive difference. Here's what changed under Basel III that actually matters. The capital requirements for Tier 1 assets increase from 4% to 6%. That means banks need to hold more high-quality, low-risk capital. Physical gold qualifies. Paper gold does not. So if you're a bank trying to meet your capital requirements, physical gold just became significantly more attractive relative to unallocated positions or other derivatives. This creates structural demand for physical metal. Now, there's a claim that circulates saying gold is now considered high-quality liquid assets under Basel III. The LBMA, the London Bullion Market Association, has confirmed this is not accurate. Gold is Tier 1 capital, but it's not classified as HQLA for liquidity coverage purposes. Why does this distinction matter? Because it keeps the hype in check. Gold's status under Basel III is significant, but not for the reasons some headlines claim. It's significant because it incentivizes banks to hold physical, allocated gold to meet capital requirements. That's structural buying pressure that didn't exist at this level before. The timeline matters too. The United States implementation of Basel III starts July 1, 2025, with full compliance required by July 1, 2028. Europe and Asia have already been adjusting. That means over the next few years, we're going to see continued institutional accumulation of physical gold as banks worldwide adjust their balance sheets to meet the new standards. This isn't a one-time event, it's a multi-year structural shift. Let's look at the supply and demand equation, because this is where the math starts to get uncomfortable if you're betting against precious metals. Annual gold production is around 3,000 tons. Industrial and jewelry demand takes roughly 2,000 tons. Central banks are buying over 1,000 tons. That alone absorbs essentially all available supply before you even account for ETFs, private buyers, or any other demand sources. We're in a structural deficit, and unlike stocks or bonds, you can't just print more gold. Production is limited by geology and extraction costs. Silver is even more interesting and, frankly, more volatile. Silver has significant industrial demand that gold doesn't. 16% of silver demand comes from solar panels. 3% from electric vehicles. It's used in electronics, medical equipment, and increasingly in AI server infrastructure because of its thermal and electrical conductivity properties. This means silver has a floor of industrial demand that exists regardless of its monetary role. And that industrial demand is growing as the world electrifies and digitizes. But here's the problem. Silver production is constrained. Many silver mines are actually byproducts of copper, lead, or zinc mining, which means silver supply doesn't respond quickly to price increases. And some countries have started restricting silver exports to ensure domestic supply for their own industrial needs. Meanwhile, physical silver demand is intense. If you try to buy physical silver in size right now, you're looking at 3 to 4 month delivery times and premiums significantly above the paper spot price. That spread between paper and physical is telling you something. The physical market is tight. Which brings us to the paper markets and the big question everyone's dancing around. How much paper, gold, and silver exists relative to physical metal? The CME, the Chicago Mercantile Exchange, has raised margin requirements for gold and silver futures multiple times over the past 2 years. When they raise margin requirements, it forces traders to either put up more cash or reduce their positions. This is a deliberate cooling mechanism. The question is, why do they need to cool the market? One argument is that the ratio of paper contracts to physical deliverable metal has gotten uncomfortably high. Here's how it works. Futures contracts represent a promise to deliver metal at a future date. But most futures contracts are settled in cash, not physical delivery. The system works as long as only a small percentage of contract holders actually demand physical delivery. But COMEX inventories, the actual physical metal sitting in registered vaults, are a tiny fraction of the total open interest in paper contracts. If even a modest percentage of longs demanded physical delivery simultaneously, the system would be in trouble. And that's exactly what some large buyers have been doing: taking delivery, draining physical inventory, creating pressure. Now, I'm not saying the paper market is going to collapse tomorrow, but the divergence between paper prices and physical availability is real. And historically, when that gap gets wide enough, the paper price eventually has to adjust to reality. You can't deliver metal that doesn't exist. At some point, physics wins. There's also the gold to silver ratio, which has historically averaged around 17 to 1. That means throughout history, it took 17 ounces of silver to equal the value of 1 ounce of gold. Right now, with gold over $4,600 and silver around $85, the ratio is roughly 54 to 1. If that ratio were to revert even halfway back to its historical average, silver would need to move significantly higher relative to gold. This is why some investors favor silver over gold for price appreciation potential, even though silver is far more volatile and industrially dependent. What I'm about to tell you next is the thing that took me years of reading central bank reports and trade data to fully understand. This isn't about gold and silver going up. It's about what they represent in a changing monetary architecture. For 75 years, the world ran on a system where oil was priced in dollars, which meant every country needed dollars to buy energy, which meant every country needed to hold dollar reserves, which meant they bought US Treasury bonds, which allowed the US to run massive deficits without immediate consequences. That system, the petrodollar, is not ending overnight, but it's evolving. Saudi Arabia is now accepting payment for oil in multiple currencies. The Chinese yuan, the euro, even digital currencies are on the table. This doesn't mean the dollar is obsolete. It means the dollar is no longer the only option. And when you're no longer the only option, you lose pricing power. The implications are massive. If global demand for dollars decreases because countries don't need as many to buy oil or settle trade, what happens to all those existing dollars? They come home. And when they come home, they either bid up the price of US assets or they decrease the purchasing power of the currency. Inflation. Debasement. The slow erosion of what a dollar can actually buy. This is why central banks are buying gold. Not because they think gold is going to the moon, but because they know their currencies are going to lose purchasing power relative to hard assets. Gold doesn't pay interest. It doesn't generate cash flow, but it also can't be printed. It can't be debased, and it's accepted everywhere, by everyone, regardless of political system or currency regime. It's the ultimate neutral reserve asset. So where does that leave you? If you're sitting there wondering whether to buy gold or silver at these prices, here's what you need to understand. This isn't a trade. It's not about calling the top or the bottom. It's about understanding that we're in the middle of a multi-decade shift in how the global monetary system operates. And in that environment, holding some allocation to hard assets that central banks are accumulating is not speculation, it's positioning. I'm not going to tell you to put everything into gold. That's insane. Diversification still matters. Real estate, quality businesses with pricing power, stocks and companies that own hard assets or have the ability to raise prices in an inflationary environment. These all have a place, but the argument for precious metals right now isn't about getting rich. It's about preserving purchasing power while the monetary regime shifts underneath us. Here's what the professionals are doing. Most wealth advisors will tell you 5 to 10% of a portfolio in precious metals is reasonable. Some people favor gold because it's less volatile, easier to store, and has that Basel III institutional support. Others favor silver because of the industrial demand story and the potential for the gold-to-silver ratio to compress. There's no single right answer. What matters is that you're not holding 100% of your wealth in currency that's being deliberately devalued to manage unpayable debts. The other thing to understand is that gold and silver are monetary insurance. You don't buy insurance hoping your house burns down. You buy it so that if your house burns down, you're not destroyed. If the dollar maintains its dominance and the monetary system stays stable, your gold and silver will probably just keep pace with inflation. You won't get rich, but you won't get poor either. But if we're right, if this is a structural shift, if the dollar's reserve status continues to erode, if central banks keep accumulating at this pace, if alternative payment systems gain traction, then the metals aren't expensive right now. They're still early in the repricing process. And here's the uncomfortable truth. Everything I just described, the repatriation, the alternative trade systems, the Basel III changes, the central bank accumulation, this isn't speculative. This is documented. This is happening. The only question is how fast it plays out and how severe the adjustment will be. Because adjustment is coming. You can't run 50-year high debt to GDP ratios, print currency at the rate we've been printing, and weaponize the reserve currency through sanctions without consequences. The consequences are showing up. They're just showing up slowly enough that most people aren't connecting the dots yet. We're in the home stretch now, and I need to bring this back to something tangible you can actually do. If you decide some allocation to precious metals makes sense, here's what you need to know. Physical metal is different from paper metal. If you're buying for monetary insurance, you want physical. Coins, bars, something you can hold. ETFs and futures have their place for trading and liquidity, but they're not the same as physical possession. And if the scenario plays out where paper and physical diverge significantly, you want to be holding the physical. Storage matters. Small amounts you can keep at home in a safe. Larger amounts might require allocated storage at a professional vault. Allocated means it's your metal, specifically identified, segregated, and insured. Unallocated means you have a claim on a pool of metal, which brings us back to counterparty risk. If the institution fails, your claim might be worthless. Allocated is more expensive, but it's the whole point. You're buying physical metal to eliminate counterparty risk, not to create new counterparty risk with the storage provider. And here's the final thing to understand. This is a slow-moving process. You're not late. You're early to the middle innings. The repricing of gold and silver relative to fiat currencies in a world with multiple reserve currencies instead of one dominant reserve currency is going to take years, possibly decades. The central banks buying right now aren't trying to flip their positions in 6 months. They're repositioning for a different monetary era. And if that's the game they're playing, maybe it's the game you should be watching. So here's what you do with this information. First, if you want me to break down another topic, whether it's real estate in this environment, how to position equity portfolios for currency debasement, or the actual mechanics of how BRICS pay or alternative settlement systems work, tell me in the comments. That's what this channel is for. Second, look at your own financial position. How much of your wealth is in currency or currency-denominated assets? How much is in hard assets? Is that ratio one you're comfortable with if the purchasing power of currency continues to erode? Your future wealthier self, the one looking back 10 years from now, is either going to thank you for understanding what was happening and positioning accordingly, or wonder why you had all the information and didn't act on it. The central banks are telling you what they think is coming. They're buying over 1,000 tons of gold per year. They're repatriating physical metal. They're building alternative payment rails. That's not a conspiracy, that's policy. The question is whether you're paying attention to what they're doing or just what they're saying. Because what they're doing is buying gold, and they started buying long before it hit $4,600 an ounce.